Awful home sales update. Hey everyone, it's Wolfgang. Thought I'd update everyone on the state of the U.S. housing market. It's bad. The housing market is bad, with a couple of exceptions I'm going to describe. Okay, so there's silver lining in parts of the country, but there's a lot more of the country that's in bad shape. So the problem is unemployment is quite high in some states. I'm going to tell you what states those are. When unemployment is high, it takes a lot of people out of the mix in terms of being able to buy a home. People who are jobless, the last thing they think about is applying for a home loan to buy a home. So unemployment is high in California. This is the highest in the country right now, 5.5% unemployment. That may not sound like much, but I will describe a state in just a short time here that's under 4% unemployment. California has a very high jobless rate, 5.5%. Not only that, their home prices are very high because of speculation. We resided in that state for quite a while. There's a lot of speculation, especially from offshore people buying homes in the California real estate market, that has pushed prices up to an astonishing degree. When we lived in Sunnyvale, the median home price, I believe, was around $250,000. This is when we were younger. Sunnyvale, the median home price is well in excess of $1 million. I think it's over $2 million now. So there's a lot of speculation in the California home market. Nevada has a 5.4% jobless rate, unemployment rate. So the U.S. average unemployment rate is only 4.2%. Those are the BLS numbers, Bureau of Labor Statistics numbers, okay? The U.S. average. Whether you believe the BLS numbers it's kind of up to you, because as I pointed out in several prior videos, the unemployment rate does not include the long-term unemployed, people who have been out of work for many weeks. Those people are no longer considered unemployed, especially if they stop looking for work. So the U.S. average is supposedly 4.2%. California and Nevada have very high unemployment rates. So the rosy jobs claims are bunk. And I've already described why in prior videos. When the Federal Reserve announces the Bureau of Labor Statistics job numbers, what they don't tell you is those numbers, part of the system is there are 3 times that the job numbers are announced. When the Fed makes their initial presentation, 1 month later, and then 2 months later. And historically, at least in the last few years, the jobless numbers have increased 1 month later and 2 months later. So the rosy announcement of the job situation in the U.S. a month later, then 2 months later, has chronically turned out to be worse than they initially reported. The rosy jobs claims are bunk. So to drive that point home, okay, in April this year, there was 8.3 months of new homes for sale in inventory. That's way high. That's a huge number. That's as bad, almost as bad as it was in the Great Financial Crisis in 2007, 2008, 2009. In May, it jumped up to 9.8 months of new homes for sale inventory. That is as bad as it was in the Great Financial Crisis. Okay, so this rosy jobs claims that everybody's doing fine, that the unemployment average is 4.2%. It's just not true. There wouldn't be these high numbers of homes for sale inventory if the jobs were that great. Because historically, a 6% unemployment rate in the U.S. was considered to be par for the course. 4.2% is quite a bit below that, and yet we're seeing 9.8 months of new homes for sale inventory, the highest since the Great Financial Crisis. So, but if you look at the increase, the 8.3% in April, and then it jumped up to 9.8 months of inventory. You know, and what this is it's the number of new homes currently available to be purchased, the number of new homes for sale, okay? In April, 8.3 months of supply. In May, it jumped up to 9.8 months of supply. That is a huge increase in inventory, okay? So the trend is in the wrong direction. So we have kind of an awful home sales situation in the country right now. The jobs claims, they keep telling us the job market is claimed. It can't possibly be true. We would not be seeing these increases in the number of homes for sale if the jobless numbers were that good. California, Nevada are even worse. So the housing market, as most of us probably know, is challenged right now, to put it mildly. So if the job market was as rosy as the Fed claims, we would not have 10 months of inventory. And I say 10 months because the trend was increasing, right? 8.3 months of new homes for sale Supply was 8.3 months. Supply jumped up to 9.8 months back in May. June, July, most certainly has increased. It's probably well over 10 months of homes for sale right now in the country. If the job market was as rosy as the Fed claims, we would not have these numbers. These numbers are as bad as the Great Financial Crisis, 2007, 2008, 2009. Somebody's lying, right? So either the people tracking the number of homes for sale, people in the real estate industry are lying, or the people reporting the jobs numbers are lying. And I'm sorry to put it in those terms, but I believe the jobs numbers are being purposely manipulated. And I brought this up in past videos. I don't think the unemployment rate is, and we already know that once you're a long-term unemployed person, you fall off the rolls. You're no longer considered unemployed when you've been out of work long enough. If you've stopped looking for work, you're not even considered unemployed. So why are people not buying homes right now? If we have this much supply and the U.S. unemployment is that low, 4.2%, why are people not buying homes? Let's just assume, for the sake of argument, that the 4.2% unemployment is true. I don't think it is, but let's just assume, hypothetically, 4.2% unemployment reflects reality. With this much of a supply of new homes for sale, how come people are not buying homes? Okay, so Texas has 4% unemployment. That's their state number, okay? 4% unemployment number. That state has the highest number of home sales. So you see, as unemployment drops, home sales increase. Florida has only 3.7% unemployment. So if you were thinking of a state to move to, and you're in California, that might be, one of these two states might be a good idea, right? But anyways, so Florida has 3.7% unemployment, and it has the second highest number of home sales. So there's a correlation here. As the unemployment numbers fall, the number of homes being sold increases, and vice versa. 7% mortgage rates are another factor. The unemployment rate is a big deal. When people are unemployed, the last thing they're thinking about is applying for a home loan and buying a home, right? But even if you're working, okay, if you're a working person in any state right now, assuming the 4.2% unemployment rate is legit, which I don't think it is, but let's just assume for the sake of argument, you apply for a home loan. 7% mortgage rates are killing home sales. This is another contributing factor, okay? And here's how it works. Here's how this works. When you apply for a home loan, they will run a debt-to-income ratio test on you. So let me explain what that is. If you see, I've got a note here, explain the debt-to-income ratio. So I know a lot of you already know what this is, but let me just go over this. So let's say that you want to buy a home. And let's also say that you have a car payment, a student loan payment, you're paying for health insurance, some portion anyways. You have credit card payments, and maybe some other recurring monthly payments. Those are considered to be your debts. Those are your debts, your existing debts. When you apply for a home loan, it's usually because you've already identified a home you want to buy. You know what the home is selling for. And what the bank will do, the bank you're trying to get a loan from, they will figure out what the mortgage payment would be for that home, the one that you're trying to buy. And they will add it to your existing payments. Your existing payments, car payment, student loan payment, health insurance, a portion of your health insurance, credit card payments, and they will add in the projected monthly mortgage payment, okay? That becomes your monthly debt payments. They will divide that by your monthly income. That's the debt to income ratio. The debt on the top, all your payments, including the new mortgage payments, divided by your monthly income, okay? If that ratio exceeds 44%, you're going to have a tough time getting a home loan. In other words, the bank is basically saying, the number of monthly bills you have compared to your income is about 44%. So 44% of your monthly income is going out to payments, debt payments. And if you get to that high of a level of debt, it becomes hard to get a home loan. Okay, so the 7% mortgage rates are killing home sales. Why? Okay, here's why. Because the home loan, the mortgage payment that the bank calculates is based on the interest rate. The lower the interest rate is, the lower the mortgage payment. So you see how this goes. If you have monthly payments of a car payment, student loan payment, health insurance, credit card payments, and now you have a home loan at like a 3% interest rate instead of 7%, you're much more likely to qualify for the home loan, right? But if mortgage rates are 7%, which they are right now, right around 7%, it gets harder and harder to qualify for a home loan. And that is why people are not buying homes, right? We have 9.8 months of new homes inventory for sale in the country. That's as bad as it's been since the great financial crisis. The 7% mortgage rates, they factor into the debt to income ratio. If the mortgage rate, if your monthly mortgage payment is going to be high because of the 7% interest rates, that disqualifies a lot of people from getting a home loan. That's what we call a bias to reject. The bank has a bias to reject anyone who has monthly debt payments, including the new home loan payment, that exceeds 44%. There are some banks that will go higher, up to 50% in some cases, but for the most part, we need lower interest rates. Lower interest rates will help home sales. Okay, so let's see here. Let me discuss the states with the highest number of home sales. Okay, I couldn't fit everything on the board. So the states with the greatest number of home sales: Texas, 4% unemployment; Florida, 3.7% unemployment, very low compared to 5.5% for California. North Carolina has a large number of home sales compared to the rest of the country. And Midwest states, Ohio and Wisconsin, the states in the Midwest, have higher home sales. California and Nevada are in rough shape. They have high unemployment. And in California's case, the home prices are speculated to the moon. They're very high. So the states with the greatest number of home sales ranked: Texas number one, Florida, North Carolina, and then Midwest states. Okay, so what about the states with the lowest number of home sales right now? California has the worst number of home sales. And we know why. Mortgage rates are 7%, their home prices are high, and they have very high jobless rate, the highest in the country. Not a lot of home sales in California. The other problem is a lot of people are wanting to leave that state. And when you put your home for sale on the market in California, there aren't too many takers, right? So I feel sorry for those people who are trying to escape this high jobless rate in California, because there are some states that are doing a lot better. Texas and Florida, for example. If you were thinking about moving out of California, these states would be worth considering, and North Carolina and the Midwest states. Okay, so the states with the lowest number of home sales, California was the worst. Nevada, parts of Tennessee, and parts of Arizona have low home sales. So the U.S. average jobless rate of 4.2% is baloney. We're not going to have 10 months of new home inventory if the jobless numbers is that low. It's just not. It's baloney. It's just bunk. But that's what they claim. That's what they're going with. And I'm sorry to say, a lot of people believe this. They believe this. They're not looking at the inventory of homes for sale. In a normal economy, just to let you know, there's about 5 months of homes for sale, home inventory for sale, 5 months of supply. In other words, in a healthy economy, homes get bought. They get taken up by buyers. So we never get to 10 months of supply. It stays around 5 months of supply. Now, in states like Texas and Florida, the number of new homes for sale in a good economy, it just drops to like a month. In some parts of those states, if you read during the recent past, the home sales in these states, it got down to like a month or two of inventory. So, but definitely not 10 months of inventory. So, again, a drop in interest rates will help this problem. But right now we have an awful home sales market in a lot of the country. And at some point, I would hope that this number, this jobless number, will be reported more accurately. Let's put it that way. Will be reported more accurately because, again, we're not going to, if people were buying homes, we would not have a buildup of 10 months of supply of homes for sale because they'd be bought up. People would be buying the homes. There wouldn't be 10 months of supply. That's twice the average of 5 months supply. Normally, the country has about 5 months of home inventory, 5 months worth of homes for sale. In other words, it takes 5 months for buyers to buy up the homes that are currently on the market. We now are at 10 months. The jobless rate is higher than this. It's not 4.2%. It's higher. I don't know how high it is, but it's higher. The long-term unemployed people are not even included in this, so that's part of the problem. So I just wanted to give an update about the housing market. We're in bad shape. The jobs numbers are not accurate. They are being used, however. This is being used to keep these mortgage rates high. Okay, so there have been some people who, I just want to point something out here. There have been some people who have said, well, when the Fed adjusts interest rates, it does not affect mortgage rates. Okay, so here's a little explanation about this issue. Okay, back in 2007, 8, and 9, when the housing market crashed, the Fed lowered interest rates dramatically, down to almost zero. And guess what happened to mortgage rates? They dropped significantly. Okay, the whole idea with the Fed back in 2007, 8, and 9, we're going to lower interest rates. We have a huge glut. Back then they had 10 months of supply too, right? They had 10 months of homes for sale, worth of homes for sale back in 2007, 8, and 9. We got to get these homes sold. The Fed said, we're going to drop interest rates to zero. Bam. Slowly, those homes, the glut of the 10 months of supply of homes gradually got bought up, got taken up by buyers because the Fed lowered interest rates, that lowered mortgage rates. So when you hear people say, well, the Fed doesn't directly control mortgage rates, just remember, and you can look this up online, look at what mortgage interest rates were back when the Fed lowered interest rates in 2007, 8, and 9. Mortgage rates dropped. Because right now people are pointing out that, okay, if you had like a 2% mortgage before COVID hit, you're not going to want to buy a new home with a 7% mortgage rate. So we had 2% mortgage interest rates, okay, before COVID hit. For almost 10 years, we had like 2% mortgage rates. At some point, they dropped below 2%, I believe. So don't believe this claim that the Fed cannot influence mortgage rates. Yes, they can. They did that in 2007, 8, and 9 to get us out of the 10 months of inventory of homes for sale that we had back then too. So the Fed is using this jobless number, this bogus 4.2% jobless number, to keep mortgage rates high. And that is why a lot of people are pointing out that the Fed is they're ignoring the job market. They're relying on this bogus number. The job market is not in good shape. In California, if you live in one of these two states, the job market is terrible. Maybe in Texas or Florida, it's different because they have a much lower unemployment rate in their states. But in some states, the job market sucks, right? So anyways, if you have any questions about this, I'd be happy to answer any questions that you post in the comments. And I really want to thank everyone for watching, and have a great day.